Good evening. We begin tonight with historic developments across global financial markets as major indices and commodities reach unprecedented levels. The S&P 500 has crossed the 7,000-point threshold for the first time in its history, driven by a resurgence in technology stocks, particularly those positioned in the artificial intelligence sector. Simultaneously, gold has reached a new all-time high of $5,350 per ounce before settling at $5,338, while silver trading in Shanghai has hit record levels at $140 per ounce. These parallel movements in equity markets and precious metals are prompting analysis from market strategists regarding what these divergent trends may signal about underlying economic conditions and investor sentiment. The S&P 500's breakthrough above 7,000 represents a psychological and technical milestone for the broad market index. This achievement comes as technology stocks, specifically those associated with artificial intelligence development and semiconductor manufacturing, have experienced renewed buying interest. Companies including ASML, SK Hynix, NVIDIA, and AMD have led this advance, reflecting continued investor appetite for firms positioned at the center of AI infrastructure build-out. The crossing of the 7,000 level occurs at a moment when the index has gained 15% over the past 12 months. A solid return by historical standards, but one that stands in contrast to the performance of certain other asset classes during the same period. Gold's ascent to $5,350 per ounce represents the latest in a series of record highs for the precious metal. After touching this peak, the metal pulled back slightly to trade at $5,338. The advance has lifted gold's total market capitalization past $35 trillion. This year alone, gold has surged over 22%, building on substantial gains recorded in the previous year. The metal has now risen 90% over the past 12 months, far outpacing the 15% gain recorded by the S&P 500 during the same time frame. This dramatic outperformance of gold relative to equities has captured the attention of market analysts and strategists. Barry Bannister, a strategist at Stifel, has characterized the current relationship between gold and the S&P 500 as representing a major disconnect that he views as a red flag for equities. Bannister's analysis points to the breakdown in the S&P 500's performance relative to gold, noting that this type of divergence has occurred only 4 times in the past 100 years. According to Bannister, none of those previous instances ended favorably for stock market participants who held bullish views. The historical context provided by Bannister suggests that the current divergence between equity and gold performance may carry significant implications for future market direction. The specific nature of the divergence centers on the relative performance metrics between the two assets. While gold has advanced 90% over the past year, the S&P 500 has gained 15% during the same period. Even as the index climbed to the 7,000 level, Bannister observes that it is now stalling, while gold continues to push to new highs. This pattern of gold strength combined with equity market hesitation represents the type of scenario that, according to Bannister's analysis of historical precedents, typically precedes challenging periods for stock markets. In past cycles exhibiting similar characteristics, Bannister notes that stocks remained range-bound for extended periods measured in years. Bannister has extended his analysis beyond the immediate implications for equity returns to consider broader monetary and economic scenarios. He stated that even if the current environment were to evolve into a scenario where both gold and stocks continue to rise together, such an outcome would likely signal a full-scale flight from fiat currencies. Bannister characterized such a development as something that has never ended well in history, according to his statement. This observation places the current market dynamics within a framework of monetary instability and loss of confidence in government-issued currencies, themes that have recurred periodically throughout financial history. The factors driving gold's rally have been identified by market observers as relating to shifting investor attitudes toward the United States dollar. Rate cut expectations from the Federal Reserve represent one element supporting gold prices. The anticipation that the central bank may reduce interest rates makes non-yielding assets like gold more attractive relative to interest-bearing alternatives. Additionally, rising policy uncertainty under the Trump administration has been cited as triggering hedging flows into gold. Policy uncertainty creates an environment where investors seek assets perceived as stores of value that exist outside the direct influence of government policy decisions. There is also growing unease over recent shifts in the United States national security strategy, adding another layer of concern that may be channeling investment flows toward precious metals. The performance of the United States dollar provides context for understanding precious metals price movements. The dollar index, which tracks the greenback against a basket of currencies but does not include the Chinese yuan, has declined more than 10% over the past year. This represents a substantial weakening of the world's primary reserve currency over a 12-month period. The dollar has suffered its worst one-day drop since April of the previous year, 2025, following comments from President Trump indicating he was not concerned about the currency's decline. Presidential remarks about currency values carry weight in foreign exchange markets, as they can signal administration priorities and willingness to tolerate or encourage currency movements. Bannister concluded his analysis by noting that after 3 consecutive years of double-digit gains for the S&P 500, the market may simply consolidate. This assessment suggests that the index could enter a period of sideways movement rather than continuing its upward trajectory or experiencing a sharp decline. Consolidation periods allow markets to digest previous gains, work through overvaluation concerns, and establish a foundation for potential future advances. However, the context of Bannister's comment, coming after his discussion of the gold-to-equity divergence and historical precedents, suggests that such consolidation could prove prolonged and potentially frustrating for equity investors accustomed to consistent gains. The surge in the S&P 500 to 7,000 has been characterized as driven by a sudden rush back into the same large capitalization stocks that had recently cooled off. This description indicates that the advance represents a resumption of trends that had paused rather than a broadening of market leadership to new sectors or smaller companies. ASML and SK hynix have been identified as leading this charge, both companies that provide critical components for semiconductor manufacturing and artificial intelligence infrastructure. The market's renewed focus on these names sends a message that the AI trade, as it has been termed by market participants, is viewed as having significant remaining potential rather than being exhausted. Investor attention is focused on earnings reports from Microsoft and Meta, both scheduled for release after the market close. These results carry particular weight because they will provide concrete data on whether the momentum surrounding artificial intelligence is translating into actual revenue growth or whether market enthusiasm has outpaced business fundamentals. The distinction between hype and substance represents a critical question for investors attempting to value AI-related companies. Earnings reports offering evidence of monetization and revenue generation would support current valuations and potentially drive further gains. Conversely, results disappointing relative to elevated expectations could trigger reassessment of valuations across the technology sector. The timing of these earnings releases is noteworthy because they arrive at a moment when concerns about overinvestment in artificial intelligence-related infrastructure are rising. The concept of overinvestment refers to the possibility that spending on AI systems, data centers, and related infrastructure may exceed what can be justified by near-term revenue generation and return on investment. Such concerns, when they materialize in previous technology cycles, have often preceded periods of retrenchment and valuation compression. However, the market's current behavior suggests that such concerns are not yet influencing investor decision-making in a meaningful way, as evidenced by the continued strength in AI-related stocks. A development from China has added to positive sentiment surrounding semiconductor stocks. Reuters reported that China has given approval for ByteDance, Alibaba, and Tencent to purchase NVIDIA's H200 chips. This regulatory clearance removes a potential obstacle to sales for NVIDIA and signals that despite broader geopolitical tensions, commercial relationships in the technology sector retain some capacity to function. The news lifted NVIDIA's stock price by approximately 2%. AMD and TSMC, both positioned in related segments of the semiconductor industry, posted similar gains. The ability of major Chinese technology companies to access advanced chips from American manufacturers represents an important data point regarding the state of U.S.-China technology relations. Market participants are awaiting a decision from the Federal Reserve regarding interest rates, scheduled for announcement at 2 p.m. in Washington, D.C. Federal Reserve Chair Jerome Powell is scheduled to conduct a press conference 30 minutes after the rate decision is released. Markets widely expect the Federal Reserve to pause, meaning to leave interest rates unchanged at their current level. This expectation has been built into market pricing and reflects consensus views about current economic conditions and the central bank's likely policy response. However, the press conference carries additional significance beyond the rate decision itself, because this represents Powell's first public appearance since the Federal Reserve received grand jury subpoenas, an extraordinary development that raises questions about the central bank's independence. The context of the subpoenas creates an environment where Powell is certain to face questions about Federal Reserve independence and the institution's relationship with other branches of government. Central bank independence, meaning the ability of monetary policy authorities to make decisions based on economic conditions rather than political pressure, represents a foundational principle of modern monetary systems. Any perceived threat to this independence can influence market behavior as investors assess the credibility of monetary policy and the likelihood that decisions will be made based on economic rather than political considerations. The questions Powell faces during his press conference may therefore carry implications extending beyond the immediate rate decision. At the market open, the Nasdaq rose 0.6%, while the Dow Jones Industrial Average gained 57 points, representing an increase of 0.1%. These opening moves reflect generally positive sentiment, but also show differentiation across market segments, with technology-heavy indices outperforming broader market measures. This pattern aligns with the narrative of AI-related stocks driving market gains, while other sectors show more modest movement. Currency market developments have added another dimension to the day's market narrative. The Japanese yen slipped to 152.62 against the dollar as retail traders in Japan reduced their positions. Data from Bloomberg shows that Japan's retail traders cut 85.7 billion yen, equivalent to $561 million, in net short positions on the dollar-yen pair between Friday and Tuesday. This represents the largest unwinding of such positions in any three-day period since October 2022. The magnitude of this position reduction indicates that retail traders, who had been betting on yen's strengthening, chose to exit those positions as the yen's rally encountered rumors of potential intervention. The role of Japanese retail traders in currency markets is substantial. These participants routinely generate 451 trillion yen in monthly trading volume, a figure that dwarfs official spot foreign exchange flows. The behavior of this group therefore carries market-moving potential. Their exit during the yen's biggest three-day gain in over a year suggests that some participants were cutting losses, while authorities signaled potential coordinated action with the United States Treasury. The interaction between retail trader positioning, exchange rate movements, and potential official intervention creates a complex dynamic in currency markets. On Wednesday, the yen declined 0.3% to 152.62 per dollar in Asian trading, following 3 consecutive days of 1% daily gains. The dollar-yen pair climbed back to 152.73, representing an increase of 0.35%. These movements illustrate the volatility present in currency markets and the rapidity with which trends can reverse or pause. The 3 days of 1% gains, followed by a reversal, demonstrate that momentum in currency markets can shift quickly based on positioning changes and shifting expectations about official intervention. Other Asian currency pairs showed varied performance against the dollar. The dollar rose 0.35% against the yen to 152.73. Against the South Korean won, the dollar slipped 0.25% to 1,428.23. Against the Chinese yuan, the dollar ticked down 0.12% to 6.946. The euro declined against the yen, falling 0.17% to 182.91. The Australian dollar fell 0.27% against the US dollar to 0.699, while the New Zealand dollar slid 0.36% to 0.602. Against the Indian rupee, the dollar gained 0.37% to 91.793. Against the Thai baht, the dollar climbed 0.42% to 31.03. The Australian dollar against the yen remained flat at 106.79, while the dollar edged up 0.37% against the Hong Kong dollar to 7.802. These currency movements across multiple pairs illustrate the complex and interconnected nature of global foreign exchange markets. Each bilateral exchange rate reflects the relative economic conditions, monetary policies, and investor sentiment regarding the two currencies involved. The mixed performance across different currency pairs indicates that market dynamics vary across regions and that the dollar's performance is not uniformly weak or strong against all currencies, but rather shows differentiation based on specific bilateral factors. The euro has experienced particularly notable strength, surging past $1.20 for the first time since June 2021. The common currency jumped as much as 1.7% to reach $1.20.81. This movement occurred after President Donald Trump stated he was not worried about the dollar losing ground. Trump told reporters on Tuesday that he thought the dollar was doing great and did not perceive the currency's slide as problematic. These comments from the president opened the door for more bullish positioning in the euro, as market participants interpreted the remarks as indicating that the administration would not take action to support the dollar or express concern about its weakness. The options market is providing signals about expectations for further euro strength. The market is now showing the highest premium for upside euro hedges since March 2020, indicating that traders are willing to pay elevated prices for protection against further euro appreciation, or alternatively viewed, for the ability to profit from continued euro gains. When options premiums reach levels not seen since a specific prior date, it suggests that market positioning has become quite one-sided, with a concentration of bets or hedges in a particular direction. The March 2020 reference point is significant because it corresponds to the early period of pandemic-related market disruption, a time of extreme uncertainty and volatility. The dollar's weakness has extended beyond its impact on the euro to influence other major currencies. China's yuan reached a 32-month high, touching 6.9449 against the dollar before settling at 6.9457. This represents the strongest level for the yuan against the dollar in 2 years and 8 months, indicating substantial appreciation of the Chinese currency. Beijing has actively contributed to yuan strength through its management of the currency's daily reference rate. The People's Bank of China pushed the yuan higher with a stronger midpoint fix of 6.9755, described as the most aggressive daily adjustment since August. While this fix remained 524 pips softer than Reuters' estimate, it nonetheless marked a clear signal from the Chinese central bank regarding its currency preferences. Chinese exporters are contributing to yuan strength through seasonal dollar conversions. At year-end periods, exporters who have accumulated dollar revenues from international sales typically convert portions of those holdings into yuan, creating natural buying pressure for the Chinese currency. This seasonal flow is adding to the broader trend of dollar weakness and yuan strength. The offshore yuan, which trades more freely than the onshore currency, was trading just below 6.939, holding steady and showing alignment with onshore pricing. Technical measures of currency market conditions show that onshore versus offshore dollar-yuan swaps both exhibited a negative 4.65 pip movement overnight. 3-month Shanghai interbank offered rate, known as SHIBOR, came in at 1.6%, slightly below the 1.8% Chinese offshore interbank rate. These interest rate differentials and basis swap movements provide information about funding conditions and the relative tightness or ease of currency availability in different markets. The yuan has gained 0.7% during the current month, building on a 4.5% gain recorded in 2025. These cumulative gains reflect sustained pressure on the dollar and consistent demand for yuan, driven by what has been characterized as relentless greenback selling and solid end-of-year demand from China's exporters. The magnitude of yuan appreciation, particularly the 4.5% gain over the prior year, represents a significant move for a currency that is managed by its central bank, rather than floating freely in response to market forces. Returning to precious metals, gold's performance merits detailed examination given the historic levels reached. The metal hit a record high of $5,450 before pulling back to $5,338. This action lifted gold's total market capitalization past $35 trillion, a figure that contextualizes the scale of the global gold market. The metal has surged over 22% during the current year, demonstrating that the rally remains active in the present period, rather than reflecting solely historical gains. The characterization of investor behavior notes that participants continue bailing out of the US dollar and sidestepping government bonds in developed markets, two traditional destinations for safe haven flows. The shift away from developed market government bonds represents a notable departure from historical patterns. Typically, when investors seek safety during periods of uncertainty, they purchase government bonds issued by stable developed economies, particularly U.S. Treasury securities. These bonds have historically been viewed as among the safest assets available, backed by the taxing power of major governments and offering liquid markets. The current description of investors sidestepping these bonds suggests a breakdown in this traditional relationship, potentially reflecting concerns about fiscal positions, monetary policy credibility, or political stability in developed economies. Growing unease around Washington's policy direction has been identified as a factor pushing investors away from traditional safe haven options. When policy direction becomes uncertain or unpredictable, it can undermine confidence in assets whose value depends on government stability and policy consistency. Bonds, in particular, fall out of favor in such environments because their fixed payments and long durations make them sensitive to policy changes affecting inflation, taxation, or creditworthiness. The vacuum created by reduced bond demand is driving capital flows directly into gold, an asset whose value does not depend on any government's policy choices or fiscal condition. Silver has demonstrated performance that, while receiving less attention than gold, is nonetheless extraordinary in its own right. In Shanghai, silver is trading at $140 per ounce. This level has been described as fueled by strong industrial demand and yuan volatility. The premium of Shanghai silver prices over global prices points to tight supply conditions in the Chinese market, or alternatively indicates a concentrated wave of buying from local purchasers. Silver serves both as a precious metal with investment demand and as an industrial commodity used in electronics, solar panels, and various manufacturing applications. The characterization of strong industrial demand suggests that Chinese manufacturing activity is creating genuine consumption needs for physical silver. Silver has been advancing for an extended period, and the metal just recorded its biggest monthly gain since 1979. The reference to 1979 is particularly significant because that year falls within the period of the previous major silver spike, when the Hunt brothers attempted to corner the silver market, driving prices to then record levels. For the current monthly gain to exceed all monthly gains between that period and the present indicates extraordinary momentum. Silver is now up nearly 60% in January alone, and the metal more than doubled in value during 2025. These percentage gains substantially exceed those of gold, reflecting silver's characteristic of displaying higher volatility and larger percentage moves in both directions compared to its more expensive precious metal counterpart. The surge in silver prices is triggering massive trading activity in silver-related investment vehicles. The iShares Silver Trust ETF experienced $40 billion in turnover on Monday. To place this figure in context, it is described as being neck and neck with State Street's SPDR S&P 500 ETF, one of the world's largest and most liquid exchange-traded funds. The comparison to individual stock volumes further illustrates the magnitude. Nvidia stock recorded $23 billion in turnover, and Tesla registered $22 billion. The fact that a silver ETF is generating volumes comparable to or exceeding those of the S&P 500 ETF and major individual technology stocks indicates that silver has captured intense market attention and speculative interest. Just a few months earlier, silver ETF volumes were approximately $2 billion daily, before climbing to $10 billion in December. The acceleration from $2 billion to $10 billion to $40 billion over a period of months illustrates the exponential increase in trading interest. As market participants await the Federal Reserve's interest rate decision and major technology earnings reports, equity index futures are showing positive movement. S&P 500 futures are up 0.41%. NASDAQ 100 futures are climbing 0.93%, reflecting the technology sector's strength. Dow futures are ticking up 21 points. These pre-market movements suggest that investors are positioned for potential positive developments from the Fed meeting or earnings releases, though futures movements do not always predict the direction of regular trading session results. The confluence of these various developments, the S&P 500 crossing 7,000, gold reaching new record highs above $5,300, silver trading at record levels in Shanghai, the dollar experiencing substantial weakness, and major currency realignments, creates a complex market environment requiring careful analysis. The observations from strategists like Barry Bannister regarding historical precedents for the current gold-to-equity divergence add a cautionary note to what might otherwise be interpreted as uniformly positive market conditions. The fact that gold and equities are both at or near record levels, but with gold vastly outperforming on a percentage basis, suggests that different investor groups may be responding to different perceived opportunities or risks, with some seeking growth through equities and others seeking preservation through precious metals. We will continue monitoring these developments as the trading day progresses, with particular attention to the Federal Reserve announcement, Chair Powell's press conference, and the major technology company earnings reports that will provide concrete data on the state of the artificial intelligence sector and the broader economy.